It's a secret that the lenders don't want you to know. This is a hidden number that most gurus aren't talking about, that your favorite financial advisor isn't going to tell you about, and that even your banker isn't going to tell you about, especially when it's time to go for funding. My name is Jamal. I'm the credit protector. Welcome to the channel, and I help individuals and small business owners get funding. I'm also a credit coach, credit strategist, and credit card enthusiast. So I like to talk about a little bit of all these different topics. Today, we're going to be talking about a hidden item that can keep you from getting denied. Getting a handle on this one thing can drastically increase not only your approvals, but the dollar amount that you're actually approved for. And no, this is not your credit score. We're not talking about credit card utilization. We're not talking about the age of your credit report. This is something that's totally different. I've literally seen people get denied the American Express Platinum because this number wasn't in the parameters that they were looking for. It's also a number that's very important when we're talking about closing on a mortgage. So, home buyers, this is super important. And if you're in the real estate game, this number can be very important. Okay. And we're going to talk about how to use it, how you can make sure that you're in the right range, and how you can check it yourself. Now, this won't be a super long live because I got a dentist appointment at 11. Um, and also, once you have this information, this is one more thing that you can use to ensure that you are in position for funding. My goal, especially with these lives, is to just give you guys the blueprint and the foundation so that you know you're ready for funding. I work with far too many clients who actually, I just had a conversation with a client yesterday. We got her business set up, right? My team is working on her credit, and we got her LLC, her virtual address, her phone number, email, website, EIN, right? Articles of organization, and her DUNS number, right? Nobody out here is really setting you up like that to even include your DUNS number. So when she's ready to build out her business profile, she all she has to do now is just start applying using her business credit. In the meantime, my team is working on improving her personal credit because it's a combination of both. You need to have all of these pieces of the puzzle together so that you can maximize the amount of funding that you can get for your business. Now, what is this secret number that we're talking about? What is this secret number that you usually don't hear a lot about? Everyone talks about your credit profile. Everyone talks about your data points, right? Making sure that you have at least two when we're talking about business funding, especially if you're doing PG and you're doing credit stacking or the credit card stacking method, you want to make sure that you have at least 5 years of age. 3 years right now is too short, is not good enough. You want to have 5 years of age. With those accounts, you want to have a minimum of 5 accounts. Two of those five, and these are 5 accounts that belong to you, not 5 accounts that are AUs, authorized users. You don't want 5 authorized users, you're going to get denied. So you need to have 5 primary accounts that are yours that are at least 6 months old. At least 1, 2 months, you're going to get denied. All right. I was actually just looking at a credit profile. He had a strong score, right? It was in the 700s. He had about 10 accounts, but his average age was only 3.5 years. And what happens now, this still isn't the secret, but what happens now is that lenders can see when you're using authorized users. It's right there on their screen. They mark it authorized user. So now when they're checking you for lending opportunities, right? What they're going to do is actually filter out all of those authorized users. So he had 5 brand new accounts. They were only 1 to 2 months old. And then he had 5 authorized users. Those were older with bigger limits. And he got approved for like a credit card that's pretty easy to get, but he was going for Key Bank, and Key Bank just kept denying him. So basically, the workaround was that he just doesn't qualify for Key Bank yet. He has to go to a different lender. And that's just how it is these days, right? You got to know and understand what values are important to which lenders. Key Bank, they're checking to see if you're using authorized users to beef up your credit score, and they not rocking with it. They want to see that you have at least 5 accounts that are at least 6 months old with perfect on-time payment history. You also want to make sure that your utilization is low. So we're talking about 30% or below. Can you get funding with 30% utilization? Absolutely. You can get approved for business credit cards all the way up to about 40%. But when you do that, you're going to be experiencing lower approval amounts. All right. So is it possible? Yes. Is it the best? No. But just put it out there. If we're talking about you want maximum funding, you want the $100,000, $150,000 Chase business credit card, then that utilization needs to be at like 1%. You need to be showing some heavy cash flow going into that bank account. All right. So that's just some background. Now, this secret number that I'm talking about that can help you get higher approval limits for credit cards, for lines of credit, for loans, for mortgages, for auto loans. It's a number that you don't find on your credit report. It's a number that you're not going to see, and that most lenders don't tell you up front. Most lenders only mention your credit score, but this number goes beyond that. This number is your debt to income ratio, aka your DTI. Now, if you already been through the home buying process, you're probably familiar with this. DTI comes into play more so when you're going for installment loans. Installment loans includes, personal loans, a business loan, a SBA loan, a auto loan, and a mortgage. This is basically is represented as a percentage, and they use this number to determine can you afford this debt, right? Are you able to pay me and pay all your other bills? And that's how they use this particular number, right? It's usually expressed as a percentage. So, you got 20% DTI, 40% DTI. A lot of lending is just based on the numbers. And I'm giving you guys this so that you can take and look at your own numbers, right? And determine your DTI. So before you go out applying, you'll already know if you're in position. That's what all this information is for. You got to know if you're in position, because the worst thing you want to do is just apply for stuff blindly because you saw it on the internet and you didn't do the research. You didn't make sure that you were in position, and now you're getting hit with denial after denial after denial. Plus, you're wasting all of your inquiries. Because remember, when you're going for funding, when you have too many inquiries, like once you're over 4 inquiries, that can also turn into automatic denials, because they don't want to see you. They don't want to see you do all of these application runs, right? They absolutely don't want to see that. So what happens is that this is one more factor that you can use in order to make sure that you are in position. So let's talk about how to make sure you're in position, and so that you can check your DTI for yourself. It's a pretty simple formula. All right. All you're going to do is just take your monthly. Well, you can calculate your DTI in 2 ways. You can calculate it based on your monthly expenses and income, or your annual expenses and income. Okay. So it's very easy. My bad. All right, and I just want to be able to pull this up. Okay, so all you do, and I'll show you a quick resource. This is a calculator that is on. Now this is from Wells Fargo. You know, I'm not a huge fan of Wells Fargo, but you see here, it's a very, very, very easy formula. You're going to take your income. Now this is for annual income divided by your monthly payments. Your annual income is before taxes. So we're talking about your gross income, your gross. All right. This doesn't include any deductions whatsoever. You're going to take that and you're going to divide it by your monthly expenses that appear on your credit report. This is also very important, that appear on your credit report. So any debt that shows up on your credit report, you want to basically write down all of those expenses, right? At get the sum total of that, and then you're going to have your gross annual income and you're going to divide it by the sum total of your monthly payments. That's going to get you your DTI percentage. Okay? It's very simple. To calculate your estimated DTI, simply enter your current income and payments. Okay? So what they use this number for, they use this number to figure out whether or not you can afford the mortgage that you're going for, or that if you can afford the car that you're going for. Credit cards also have their own internal DTI requirements that they don't make public, right? So most companies, when we're talking about lending, you want to have a DTI percentage of no more than 40%. Once you're over 40%, you're basically in the red zone, the no-go, right? You're typically going to get denied for just about, you'll once you're over 40%, you'll get denied for a mortgage. You'll get denied for American Express Platinum, okay? Um, those are the two biggest ones. Auto loans, they'll still rock with you because, auto loans, they don't care because it's secured, right? They're secured, so they don't really care about whether or not your DTI, like they care a little bit, but not as much as a mortgage. Okay. Now, this also comes into play on the business side. They check your DTI. Now, on the business side, they call it something different. Instead of it being a DTI, they call it your debt service ratio. But it's essentially the same thing. They're looking at your revenue and then they're going to divide the revenue by your business expenses. That's going to be your debt service ratio. With that ratio, they're going to determine whether or not you qualify for their line of credit, their credit card, their MCA, their business loan, their factoring, right? They're going to determine if you qualify for that. It's also going to determine the amount that they qualify you for, because they do have minimums and maximums. They want to know if you can pay them at all based on this debt coverage or debt service ratio. I want you got so those two numbers are super important. Again, these are behind the scene numbers. They're not publicly discussed. And it's important to know about these numbers because a lot of times you won't even see it on your denial letter, right? You may get what's called an adverse action letter or basically your rejection letter, denial letter. And it may say a lot of different things. Age of accounts too young, too high of outstanding balances, too many open accounts, too many new open accounts, something of that nature. But very few of them are going to say your debt to income ratio is too high. I've never seen that on any letter at all. And they never actually tell you that your debt to income ratio is too high unless you're going for a mortgage. That's really about the only time I've really seen them verbalize anything regarding your debt to income ratio. Most credit cards don't talk about it, even though they look at it, but they don't talk about it. And auto loans typically don't mention it. Neither do business lines of credit. They typically don't mention it when you're going for that. It's one of those hidden gems that once you know about it and once you can calculate it. I actually was speaking to a banker. He was like, you want to know the DTI and the debt coverage or debt service ratio, and that will actually allow you to know if you have a deal at all. Because you have, when we're talking about being a loan broker or being someone that helps small businesses acquire capital, I have to know whether or not you already pre-qualified. One of my duties, right, as your coach, your consultant, your liaison, your confidant, right, a member on your team to help you and your business scale, is I have to make sure you're in position. Part of that is doing my own due diligence and pre-qualifying you before we go to these banks, before introducing you to any lenders. Because the last thing that you want, is to go through, introduce you to a lender, connect you with a banker, connect you with a lender, and you don't qualify, right? It's a blow to the ego. It can be discouraging, and you just feel bad at the end of it. You know what I mean? You go through, you fill out all this paperwork just to get denied. Nobody wants that. We don't want that. So it makes more sense for us to do all the due diligence up front. And you guys probably seen my lives in the previous throughout the week, where I've been reviewing personal profiles, reviewing credit reports, right? Talking about alternative lenders, things of that nature, other lenders where you can get alternative financing, no doc programs, right? No hard pulls, business only fintechs. All of this is because you build out programs specific to your client so that they can be successful. That's what it's all about. So the debt to income ratio is super important. On the business side, is the debt service or debt coverage ratio. Super easy. You take your gross revenue or your gross income, you're going to divide it by your monthly debts. The debts are the debts that you can see on your credit report. So that would be any monthly payments for loans, any monthly payments for your credit card. This is your monthly payment. This is not, you're not looking at the total value of the loan. So if you have a house, your DTI is going to be your income divided by your mortgage payment. It is not your income divided by the value of the home, right? So that's the So hopefully that was helpful to you guys. If you're in position that you're looking for business funding, you want to go for business funding, you're looking for someone to help you with that process, you could definitely book a 30-minute consultation with me. We just went over the debt to income ratio, how to calculate it. We also spoke about the debt coverage ratio and how to calculate that. This is just one of many other factors that the banks and lenders used to get you some funding. It's going to be one of the many factors that I use to help you get funding, because that's my job. Everyone have a great day. Thanks for tapping in. Remember to like, subscribe, leave a comment once this video, double back, leave a comment so that how to contact me, you can click the link and book a 30-minute consultation. The link is actually pinned in the comments. So you just book that consultation and we can go through, discuss your situation, right? What you're looking for, your goals, what type of business you have, what type of funding you're looking for, and we can go from there. So just click the link, book the consultation, the 30-minute. The booking link is also in my description, the channel description, etc. Right? So you go ahead, book that, use the link, book, and we can hop on the call for 30 minutes, talk about your situation and how I can help, and see if you're in position and how I can help you get into position, right? Always want to act sooner rather than later. You want to get in position now. You don't want to wait until the last minute, because that's when things are going to get jammed up. Had a young lady, she quit her job. She's like, hey, I want to get into the taxes. I'm looking for funding. I'm like, okay, cool. All right, cool. Do you have a business? She's like, yeah, I have an EIN. I'm like, cool. What else do you have? An EIN by itself is not a business. That's just a number. You need to make sure that you're registered with the state. You want to make sure you have a business bank account, and you want to make sure that you start cash flowing through that business bank account. You also want to make sure you have a payment processor. So I know we love to take Zelle, Cash App, PayPal, right? I've been there. I get it. People want to pay you how they want to pay you. I'm all about accepting the money however I can accept it. The other thing though is when people have debit cards, credit cards, and you're transacting over the internet or your website, you want to be connected to a payment processor. So that's Stripe, that's Square, that's authorized.net, right? There are a lot, 5 Star Processing. There are a lot of different payment processors that you'll need so that you can start accepting cards, debit cards, credit cards, charge cards, right? So definitely make sure that all of that is set up. If it's not set up or you need help setting that up, also book the 30-minute consultation. We can go through that and I can tell you how to go about setting all that stuff up. All right. So that's everything, y'all. Appreciate everyone tapping in. I will talk to you guys later. Peace. Boom. Darnell, definitely make sure you contact me. Book that link, bruh. Book the link. Click the link to book, right? So that we can get you set up. We can get you tapped in.